What a week on the stock market. It was basically a bloodbath. Companies like NEO are down by 20%, Tesla 20%, and Apple 10%. A lot of the gains of the last couple of weeks are just gone. But what actually happened? Everybody is expecting a market crash currently. The reason is that since last year, after the huge crash in March 2020 due to the pandemic, the stock market only knew one direction, and it was going upwards. Now, after 12 months, everybody is used to making money on a daily basis, and falling prices are also part of the game. A lot of people just forgot that, especially those paper-handed guys and girls who sold their Tesla, NEO, and Apple shares recently. But actually, what happened on the market and what actually caused the markets to go down? Kathy Wood from the ARK Fund has an interesting explanation.
It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term. I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
Rising bond prices created a little bit of a scenario where the markets started to go down because money was flowing to other investment opportunities. Is that sustainable? When I look at what Jerome Powell said recently, I don't think that rising interest rates in a stumbling economy is in everybody's interest. The reason is quite simple. We lost a lot of jobs, the economies were shut down, and governments want people to consume because consumption means that money is flowing back into the economy, creates new jobs, and when businesses are thriving, it's the best thing that the economy is coming back. Raising interest rates in that situation doesn't make a lot of sense because consumers simply have an option. Instead of consuming, they just put the money in the savings account because the interest rates are rising. And when they expect that the interest rates are rising any further, why should they buy anything except stock, of course? So are we in the beginning of a correction? Are we in the beginning of a huge crash similar to 2000. There are some doomsday prophets out there. Actually, I don't believe it, but what do I know? I was wrong so often in the last couple of months. But being cautious is not a bad thing, actually. What are the pros doing? Let's listen to Kathy Woods, what her strategy is.
Steve Weiss has a question for you, Kathy.
Hi, Steve.
Hey, Kathy, good to see you again. So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast, or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names in which are creating losses now, because again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to, because they've lost a lot of their pipelines or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point in the coronavirus last year, it was as low as 33, I believe.
Kathy Wood puts the money not into a cash position. She buys stocks of which she thinks that they are cash-like. So whenever a crash is coming, they are pretty much doing the same, not moving a lot upwards and not moving a lot downwards. Her safe haven of choice was and is the pharma industry, because in the pharma industry, she sees an additional upside potential due to the pandemic, in my opinion, and also due to the genomics progress that Kathy Wood was talking about. The pharma industry, old traditional pharma companies, are most likely to benefit from these two developments. If everything goes right, and I hope so, then maybe in the next 10 years, we might see a revival of the pharma industry, and maybe we have another golden age. Being a little bit cautious is not a bad thing. Diversifying the portfolio is always good. And let's see what happens in the coming weeks on the stock market. And as always, this is no investment advice. These videos are just for fun, entertainment, and sharing a little bit of my insights and my opinion and listening to the experts on the market. And always remember, when you want to invest in a stock, always do your due diligence, because at the end of the day, it's you who made the decision, and the only person to blame is the one who bought the stock. Have a nice day. Yes, and by the way, if you like my work, if you like the channel, hit the subscribe button, leave a comment, and like the video.